Taming the High Cost of College, Episode 9.
You have kids, they grow up, and before you know it, it's time to plan for college.
Where do you start?
How much is it going to cost?
Will you qualify for financial aid?
Should you be looking into scholarships?
When will you be able to retire?
What about student loans?
The list of questions is never ending. The good news is, all the answers are right here. Welcome to the Taming the High Cost of College podcast. Here is your host, certified financial planner, Brad Baldridge.
Welcome to Taming the High Cost of College. I'm your host, Brad Baldridge. This podcast is designed to help families figure out how to pay for college. So if you have a high school student and you're now just jumping into the process, or maybe you're well into the process, but you're trying to figure out how all these pieces should come together, you're in the right place. In today's episode, we are going to be talking about the 5 types of colleges out there, whether they're private or public, as well as the different buckets that they can be put in to help you kind of group colleges as far as what they might cost and how they might treat you for admissions and for financial aid. Then we have an interview with Tim Nolan. Tim Nolan is a local CPA here in the Milwaukee area. He's someone I work with on occasion with joint clients where we're trying to figure out the tax implications of what we're doing when it comes to college. So we're going to spend some time talking about the American Opportunity Credit, which is a great credit that families need to be aware of as you approach college. We'll also talk a little bit about what business owners can do as far as perhaps hiring kids into the business. So 2 great strategies that can save you thousands of dollars when it comes to paying for college. And then finally, I'll wrap things up with a Brad Recommends, where we'll talk about Meridaid.com, a website that is a great website for families to help figure out what type of merit aid is available at the particular colleges that you're pursuing. As always, this is a podcast, so if you can get more information about the podcast at iTunes and Stitcher by looking for tamingthehighcostofcollege.com. You can set up automatic downloads, so you'll get every episode as they are published, so you don't need to seek out the website every time. If you don't understand how that works, talk to your kids, and they can probably help you out. So without any more delay here, let's jump into it. We're going to start with the 5 types of colleges. So let's talk about the 5 types of colleges out there. This is just another way that families can look at colleges relative to their own academic and financial situation. But colleges fall into 5 main categories as far as lumping them together as how they may treat you when it comes to financial aid and when it comes to admissions and so forth. The 5 categories are, there's the in-state colleges, the out-of-state colleges, and then the 3 types of privates. So in the 3 types of privates, I would say there's the elite private colleges, there's the private colleges where you're a strong fit and the colleges want you, and then there's the privates that you're not quite as strong, so they may accept you, but you're not in their target market, they're not trying to pursue you. So let's talk a little bit about each of those categories then. The first is the in-state school. So if you live in California, it would be the California schools. If you live in Wisconsin, here where I live, then it would be the Wisconsin schools. But every state offers in-state schools that are at least partially funded by state funds. And therefore, generally speaking, their lowest cost state schools are, in my area, are $15,000, $16,000 a year total cost of attendance. Flagship University of Wisconsin here is $25,000 roughly. I know out in California they're more expensive, whereas their flagship schools might be pushing $30,000, $35,000. And in other places, the state schools are very reasonable for in-state residents because they're still heavily subsidized by the state, where you might go for almost free or some very reasonable prices. In addition to the state schools, there's also reciprocity. I mentioned that a while back in a previous episode number 4. So go to tamingthehighcostofcollege.com/004, and very end of that program, the Brad Recommends, there's a website, and we'll run it again here in the show notes for this episode. But there's a website that talks about the reciprocity agreements among various states. I know here in Wisconsin, again, there's a great reciprocity between Wisconsin and Minnesota. It's been long-standing, and it's very generous in that Wisconsin residents can go to Minnesota state schools for the in-state price, and the opposite is also true. Minnesota residents can attend the Wisconsin schools for the in-state price. I'm not aware of any other states that have that strong of agreement, but there are also, especially along the borders, various places where you can go to the in-state that might be just across the border. And that also applies often for technical colleges and other regional schools as well. All right, so we have the in-state schools. Again, they're the very low cost typically. A lot of families set down the rules that essentially say that we're only going to consider the in-state schools because we believe that's all we can afford. And that certainly is a strategy. Just be aware that for some families, you may be able to go to an out-of-state school because of reciprocity, or private schools even because of scholarships and loans and other aid. The actual out-of-pocket cost at a private school or an out-of-state school may or may not be higher than what you would pay in-state. So I think you really need to understand, what's available before you essentially lay down that law. For some families, it is appropriate, though. Then we have the out-of-state state schools. Some college kids like to get out of town. They want to go to a different state, a little farther away from home, and spread their wings a little bit. So if your student is considering out-of-state schools, just be aware that they have an out-of-state price, which is often 2 or 3 times higher on the cost of tuition. Generally speaking, all the other costs stay about the same. So the travel and the books and the meal plans and the room and board, all that is usually the same price no matter where you're from. But the tuition itself can often double or even triple if you're from out of state. Now, there are some states out there that are starting to try and attract students from other states into their state system. So they're willing to negotiate on that price. When I say negotiate, some of them, it's not, like buying a used car. It's more of if you have these types of grades and these types of ACT scores, or these types of SAT scores, we will consider you for a scholarship. And after the scholarship, your net tuition won't be full out-of-state price. It might be, 50% more than the in-state number. Again, depending on the state, I know a lot of states where they're having trouble attracting outside students. Iowa and Nebraska and a lot of the plain states and Midwestern states, where if they find a student that they're very interested in, again, they may have some scholarships or other benefits that they can use to try and attract, especially the strong students from out of state. A lot of colleges are trying to become more nationally known. If you're the flagship state school and you need to attract students from all over the country so that you can become more of a national school, you may need to work hard at attracting students that typically won't come from California or New York or other metropolitan areas. So you may have to offer some additional finances. Then we have the private schools. Again, the 3 categories of private schools are the elite privates where you're a strong candidate and a good fit, and privates where you're not as strong and perhaps you're average or even below average for that particular school. So the privates, of course, not all, but most have a very expensive top line price. If we talk about the elite privates, a lot of the elite privates are over $60,000 a year. Tuition, room and board, books, fees, the total cost. Now, the elite privates, and again, these would be the Ivy Leagues, Stanford and Yale and MIT and Georgetown and NYU and some of these high-priced name brand schools. The elite privates often will only base their financial aid on need base only. In other words, they attract a lot of top academic superstars, and they don't even try to figure out who's stronger as far as scholarships and those types of things. Instead, they say, we base all of our aid solely on financial aid forms and whether or not you need the aid. So certainly all the Ivy League does that, and probably another 25 or so top colleges, maybe 30 or 40, are very need-based driven. Some of the extremely elite, again, the Harvard and Stanford, also use a very generous need-based formula, where their scholarships, if you show a need, are more generous than what the typical formula would show. So if you can get accepted at these 10 or 20 top schools and you show a high need, they will do a very good job of filling your need so that the net cost of college for that student would be very low. Again, now we're talking about, the top 1 or 2% of a typical high school class that would even have a shot at these schools. So what about the rest of us at the privates? Now we're talking about schools that may be strong schools, but again, they're not the elite schools. Most of these schools now have some form of combination of merit and need-based programs. And again, depending on the school. So there's something that you can learn about as you visit and work with the schools. But a typical college, once we're off the elites, offers need and merit. And depending on how strong of a school they are, that determines where the merit kicks in. And then finally, in the private realm, we have schools where you may get accepted, but you're not a strong candidate. And in those types of schools, often they will accept you and you'll pay essentially full price, or perhaps they offer some token scholarships and merit awards. And they often take the flavor of alumni. If your parents or grandparents are alumni, they might offer you a $2,000 or $3,000 scholarship. If you participate in national merit, they might offer $2,000 or $3,000 or $4,000, depending on how far through the national merit system you made it. So again, often there's these token awards, $2,000 to $10,000 that you can compile, and they're not really tied to your academic performance or how well you actually fit at the school. It's more a typical discount. A lot of private schools out there, and studies have shown this, have actually raised their top line price so that they can offer, the $2,000, $5,000, $6,000 type scholarships to just about everybody that's going to attend. And studies have shown that parents and families like to receive the scholarship, even though they know it's essentially a discount from an increase, kind of like the jewelry store. If you go to a jewelry store in the mall and if it's not 50% off, you wonder if you're overpaying. So there has been an increase in the cost of private schools, and they turn around and discount that to a lot of students. Once you get beyond the token awards, however, that's when you start getting to substantial scholarships, whether they be need-based scholarships or grants or merit-based scholarships or grants. And for schools that are pursuing you, you have a better shot at receiving substantial awards. Now, as part of the search process, that's when you try and figure out, well, where am I a good fit academically, or where am I above average? As a rule of thumb, you want to be in the top 25% of the applicant pool in order to have a shot at receiving substantial scholarships at merit aid. So if you're looking to pursue merit aid, if you're in the top 25%, that's kind of a rule of thumb. Now, is it always 25%? Now, some schools might give merit aid to the top 30 or 40, and other schools the top 10%. And as we mentioned, there's a lot of schools out there that don't give any merit aid at all. So it's just a matter of working with the schools to find out what it takes and what they have to offer. And remember, this same merit aid may be available at an out-of-state school as well if they're trying to attract students to their particular institution. There is, of course, the schools that will not accept you at all, but obviously there's not much to talk about there because you haven't been accepted. So let's take a typical student. Let's say that you did really, really well. You have a combined score on the SAT of 2,200, let's say, or an ACT of 34, and you pursue a particular school. If it's a high-end school, essentially the elite schools, and you have a shot and you get accepted, they're going to base your aid entirely on whether or not you show a need. So some families are average middle class and they can show 20, 30, 40,000 of aid needed and they will receive it. Other families, unfortunately, are doing well and perhaps they don't qualify for any need at all. And if they don't have any need, unfortunately, the elite colleges will not offer any aid. Now, that same student could apply to colleges that want him, but that are not the elite colleges. At that point now, if he applies to a school where he's in the top of the application pool, he may get merit aid awards, say a $20,000 or $30,000 scholarship. That scholarship is based on academics, and if you show a need, you may be eligible for another $5,000 or $10,000 or $20,000. Unfortunately, the academic scholarships will fill a need if you have it. In other words, if you have a need of $10,000 at a private school and they award you a $20,000 merit scholarship, the merit scholarship fills your need and you no longer have a need, so you won't get another need-based scholarship. So merit-type scholarships will interfere with need-based aid. Now, in some situations I've seen there's families where, let's say you need $40,000, you qualify for $20,000 of merit aid, that a school may decide to give you an additional $20,000 of need-based aid to fill the entire need, half with merit, half with need. And again, for most, middle of the road type private schools, they may not be able to meet your entire need if your need is substantial, but they may try to meet your need if, let's say hypothetically you need $10,000 total. Well, then a lot of times they will fill your need. But if you needed $52,000 at a $55,000 school, they may not be able to meet your entire need. So keep that in mind as you're looking at schools, that the private schools, work a little bit differently. And it's kind of a sliding scale as far as colleges that want you and colleges that don't. So it's not a black and white where they're in one bucket or the other. If a college may kind of want you, or they may pursue you aggressively, again, depending on what they're looking for and how well you fit. So here's how it kind of works out in real life. Let's say we hypothetically had a family that was interested in Notre Dame. Strong student, they have an ACT score of 32, and they pursue Notre Dame. Well, at Notre Dame, the average ACT score is 33. So to Notre Dame, this student is relatively average. Now, I'm using just a basic ACT score. The reality at Notre Dame and most schools is they look at much more than just your test score. They look at your grade point average. They look at the rigor of your classes. They look at your extracurriculars. They look at your essays. They look at the whole package. But I'm going to simplify it to just ACT scores to kind of explain this point. So this student is slightly below average at Notre Dame. It might come through that they get essentially a token award, so maybe an alumni award or something like that. They may get accepted, but they may offer them, say, a $3,000 scholarship or a $5,000 scholarship. And the total cost at Notre Dame is $55,000, $60,000. That same student is more willing to pursue a regional private school, a Loyola, a Marquette, something like that. Now all of a sudden they may qualify for $20,000, $25,000 of aid because they're well above average of the typical applicant at that college. And again, they qualify for some of the merit scholarships that these institutions offer. Some institutions offer kind of a sliding scale where they print it right on their website where it says, well, if you have test scores and ACTs and SATs like this and GPA of that, you automatically qualify for $6,000. If your numbers are better, you qualify for $10,000. If they're the best possible, then you qualify for $16,000. Now, a lot of colleges publish that, but many more don't put that out there for public consumption, but they essentially do it behind the scenes. In the financial aid office somewhere, there's a table that delineates exactly what we've just talked about, but they don't share that with the public. They use it on a case-by-case basis, and they also might have some rules of thumb where they can bend the rules a little bit for students that they're pursuing. All right, so that same student that applied to Notre Dame and was slightly below average and had to pay full price now can apply to a regional school that might cost, say, $48,000 and be awarded a $16,000 scholarship. So now that scholarship comes off of $48,000 and now the net cost is $32,000. That same student might also be qualified to get accepted at the flagship state school in their state, which often is a pretty strong school as well, and pay a net cost there, not really receiving any scholarships, but a net cost of, say, $20,000. And then that student may also be able to apply to kind of a very small regional school that doesn't have much name recognition beyond the local community, where the average ACT score might be, say, 21 or 22, and that student would be considered a rock star. They have an ACT that's phenomenal relative to the averages. They may be in the running for a full ride type scholarship. Most colleges have one or two or three presidential scholarship or something named after a wealthy donor where you're able to get essentially 100% tuition covered or even tuition, room, and books covered if you win these scholarships. So you may be in the running for those types of scholarships at that institution. Now, the challenge for most families is a student that's strong and well qualified to attend some of the more elite institutions isn't willing to go to some of the smaller, lesser known colleges because they worked hard to get where they were. So they would like to go to the name brand school. So there's a challenge for most families in determining, well, which direction should they go? So that's, again, the basics, the 5 types of colleges out there. So think about what colleges you might be applying to and figure out how that applies to your situation. But if the overall cost of college is a driving force, I think most families need to consider the in-state state schools and perhaps put a couple of them on the list, but also consider applying to schools where you're a top candidate, where you have a good shot receiving substantial merit aid. All right, let's wrap up this segment. We're going to move into the next segment now, which is, as I mentioned earlier, a great presentation. I interviewed Tim Nolan, who is a CPA and accountant, and he's going to get into some of the tax planning that we can do with me. So enjoy. All right, I'm sitting down today with Tim Nolan. He's the owner of Nolan Accounting Center, and he's one of the accountants I work with on a regular basis with my clients to help us figure out the tax side of things. And why don't you tell us a little bit about your background? I know it's a family business for you, so how did you get involved in accounting?
Sure, Nolan Accounting Center. We've actually celebrated 48 years in business, and as you mentioned, it's a family firm, so most of that time is following in my dad's footsteps, Bob Nolan. We work primarily with small business owners, but we do an awful lot with individual tax as well. So we end up in the world of all sorts of tax issues and problems that we might be able to help resolve for both business owners and individuals.
Great. So today we want to talk about tax, but how tax and college kind of intersect. That alone is also a huge topic. So we're actually going to try and focus on just 2 tax planning strategies that are common with college planning. The first one being the American Opportunity Credit, which is a credit that's been out there for a while and it has been recently renewed again. So that has some good news. You remember when it expires?
Well, no, it'll coming up. We've got a couple of years left, and there's 2 different forms that it really fits in. You mentioned how it was expanded. When the education credits first became popular, this started as the Hope Credit, and it was good for 2 years. The biggest thing that we saw when they switched to the American Opportunity Credit is it expanded it to be eligible for 4 years of education. And so we've got the opportunity here now that we can take this for over 4 years. When things change, it'll still be available in a 2-year format, but it's that concept of can we get a couple extra years out of taking the credit now now.
All right. So tell us a little bit about the credit then. What is it essentially? I mean, first of all, what is a credit? And more specifically then, what's an American Opportunity Credit?
Right. And the big thing is that there's more than one education credit out there. So we're really only talking about one of them, but it is really the most beneficial and the most popular. But in this case, it's the concept of getting a credit, which is after your tax has been calculated. So it's really the best format. A deduction instead would be limiting or reducing your taxable income. A credit instead is actually reducing the amount of tax that you pay. So the first piece of it is the credit is coming after your tax has been calculated. And this one, even better, has a refundable portion. So even if you owe no tax, you could actually get money back in this case.
Wow. So it sounds like what you're saying is credits are better than deductions?
Usually, obviously, you can have a great big deduction that's going to be better than a credit. But when we look at the world of tax savings, a credit is usually going to be a much better opportunity.
I mean, if we quantified it, we said, well, I could either have $1,000 credit or $1,000 deduction.
Take the credit.
Take the credit because that's worth a full $1,000. Okay. So that's interesting when you say refundable. So you're saying is the government will actually send you a check if your credit puts you so positive?
Correct. Yeah. Let's just say you owe $3,000 worth of tax and you have credits of, and some of them are refundable and some are not, but you have credits that are refundable of $5,000. If your tax was only $3,000, you can actually get $2,000 check back.
Wow. So that's another benefit I wasn't aware of. All right. So what is the American Opportunity Credit? It has something to do with education. Can you explain how that's tied to education?
Sure. And the short answer is as long as you're paying qualified education expenses, which, yes, the IRS puts a lot of terms into there as to what they are. But when you think plain tuition, room and board, books, fees related to college education, that you're going to qualify. The second is it needs to be an accredited university. So accredited university means it needs to actually be recognized and participating in order to qualify for these. But there are even small community colleges and separate schools that you wouldn't go for a degree program might still qualify as accredited. So you need to pay attention to what you're doing and you might have the right opportunity to do this. But if you're paying in a 4-year degree program, which is traditionally what we're talking about for American Opportunity Credit, you're going to qualify to be able to measure this and see if it works for you.
So are there any, how much can you get back on this credit?
Well, so the maximum is actually $2,500, and that's going to be based on 2 sets of calculations. The first $2,000 is a straight dollar for dollar of dollars paid. So you get 100% of your first $2,000 that's paid in back. The second portion of it is 25% of your dollars paid. So up to $4,000, you're going to maximize the ability to take some credits back on this.
Okay, so little Johnny's off to college, and we just spent $10,000 last year in tuition, so we're going to qualify for this credit, and we'll essentially get $2,500 back.
Yeah, as long as you qualify, and there are going to be some other stipulations that are going to make it whether or not you can take this credit. But yes, that would be the short answer to that calculation.
All right. So what are the other qualifications then?
Well, income is the biggest factor that most people see. And so for married couples, if your what they call modified adjusted gross income is exceeding $160,000 to $180,000, you're not going to qualify for that credit. If you're within that range, it actually phases down. You don't get the full amount. So if your income's below $160,000 at that level, you're going to be fine. You'll qualify for the full credit, as you explained. If you're a single individual with a college student, or if you're paying your own college way to go along with it, and it's your first 4 years in a degree program, then that limit is dropped down. And so now we're talking $80,000 to $90,000 for a single individual taking these credits.
Okay, so for married, you need to earn essentially under $160,000, and single, it's $80,000.
Correct.
And that's AGI. So what does AGI stand for?
Well, it's adjusted gross income, and they further go to modified adjusted gross income. And so that's the calculation where you and your tax professional would sit down and take a look at all of your income sources and then some other deductions. And that's sometimes where you have the ability to play with things and sometimes where you don't. The most common example is going to be your retirement planning, is that ability. If you've got the ability to set money aside through your wages in order to save for retirement, you can do that tax-free or tax-deferred. And so you might make $50,000 at your job, but if you can put $10,000 away for retirement, you're only going to show $40,000 of income. And so that's where some of these adjustments will take place.
Okay, great. So how else could we perhaps reduce our income so we can qualify for this credit?
Yeah, when you're in that category of taxpayers that your income is reaching that $160,000 for a married couple or $80,000 for a single individual, you want to look for ways that you can avoid paying taxes, but still increase your income to your benefit. I mentioned before, the easiest one is retirement. So you might have either the opportunity to participate in a 401k or a 403b through your employer, or perhaps you work for a smaller employer that uses a simple plan or a SEP plan or schedules of those things, or perhaps you're self-employed and you can put a variety of different retirement plan options in place for yourself. Taking advantage of those to reduce your taxable income, or this adjusted gross income that we talk about, will help you get into these ranges to qualify for the maximum credits. Usually it's going to take a little bit of planning to make sure that you're doing the right pieces for the right reasons. Outside of that, you can do retirement plan options for yourself. But again, you have to be in a low enough bracket. But if you don't have these advantages through your employer, you perhaps would contribute to traditional IRAs on your own.
Okay, so from a practical standpoint, then, if you have kids in college or you're about to have kids in college, you need to look at your taxes from last year and see where your income landed. And, let's say it comes in, you're married, and it comes at 168. That would be a signal, because it's over 160, that maybe you want to do something.
Right. If we can maximize that credit, why not take it? If there's something you can reasonably do, let's use that 168 example, to shift that $8,000 that's over the threshold somewhere else so that it's not subject to tax. Now, usually the things I'm talking about are things that you get that money returned to you in some way. So retirement planning, you have to wait till you retire. But there's other things. One of the more common ones is if you qualify to use a health savings account. Well, that's really tucking away money today that you probably used yesterday on your medical expenses for your family. So if you're involved in a health insurance plan that has a health savings account option, maximizing your contributions to the health savings account reduces your income in this example. Could be as much as $6,000. And it's probably money that you're spending on your medical expenses. And if it's not, it's money you get to carry over to next year or the following year's medical expenses that you might still be able to use. So it's not a bad thing, and it's something that you might get a return on that money as early as right away as you go through those process.
Right. And from a college planning perspective, from my side of the fence, reducing your income can also help for need-based aid. I see that a lot with families where whatever we can do to reduce your income helps with need-based aid. If it also helps you qualify for credits, and it also reduces your overall tax bill, you kind of get three benefits for doing one thing.
Correct, yeah.
And those three benefits can add up to almost the amount of money you put away. I actually had a situation of that a couple of years ago where a family was about $20,000 too high in income. We were able to put that money into the retirement plan at work. Once we did that, we were able to get an additional credit. So we saved about $8,000 or $7,000 in taxes. We got $5,000 in credits. We did a little better on financial aid. And then we borrowed all that money back out of the 401k and spent it on college anyway. Now, going through all those hoops meant we also had a loan to deal with, so we had to come up with some cash flow. But in the end, we got $12,000 or $13,000 of benefits for $20,000 that we got to spend anyway. So that's a rare instance where it works out that well. But I think anybody that knows college is coming, if you work with a professional, probably want to warn them that it's coming and ask them to start looking into what credits might be appropriate and figure out if you're going to be over some line somewhere.
Right. It really makes the difference between waiting and seeing what might happen versus looking ahead and planning for it. And it really isn't the type of thing that, here it's November, I want to do something about this year's tax return. Well, yeah, you still can, but realistically, what we're talking about today is probably what you're going to do next year and the following year and the year after that, preparing for those years more advantageously than what you might still be able to do about this year. And so that's a lot of what is going to happen when they do that. And especially when people come and see me in February and March to get their tax returns done, I can't change your tax picture from last year anymore. It's now math. It's taking the credits that apply based on the situation you were in. We can't change yesterday, but you can plan for tomorrow.
Right. So I think that's an important point that you just made there is if you're concerned about tax credits, and you probably should be, if it's essentially money that you can take advantage of. It's free money, essentially. Start working with your tax advisor if you have one early on. In other words, say, if you have your student graduating from high school in 2014, let's say, and they're going to be starting college in 2014, then talk to your advisor in 2013 and say, hey, 2014 is a college year. Let's lay out where we're going to be. Let's figure out if we have credits that we might just miss, because if we just miss them, we might be able to fix it. I guess what you've essentially said is it's really hard to fix if that whole year is come and gone, and now you're looking back and just filling out a return.
That's correct, yeah. One of the other tools that we see people use with reducing their income, and a lot of people will think, well, this doesn't benefit me, but it's postponing things like bonuses and extra pay or pay increases. It sounds really funny to say, well, no, I don't want a pay increase. Don't give it to me right now. And realistically, what you're doing is you're saying, well, I'd rather position myself for a better return on my tax structure and postpone my bonus to whatever other opportunity might exist, or perhaps even receive it in a different form. And so sometimes that takes some creative opportunities. But when the situation exists, I've seen many cases where people will postpone a bonus in order to take advantage of something this year that they otherwise wouldn't qualify for.
Yeah, and I've seen that too. I had a family not too long ago where dad was an executive and he had a substantial bonus in the year, and it really messed things up for his college planning. And we couldn't do much about that year, but we were able to go to the boss and say, well, next year, this is how we want to structure the bonus. And he was a well-paid executive, but he also had a little bit of pull because they appreciated what he was doing at the company. So they accommodated him and allowed him to shift some of his bonuses to different tax years. And it saved him substantial money by, again, laying out his long-term cash flow year over year and saying, well, we're going to group 2 bonuses in 1 year, skip a bonus in the next year. And it helped in 2 areas. One in the tax planning, and the other area was, again, need-based financial aid, because in the years he didn't get the big bonuses, he got substantial financial aid as well.
Sure. And there's other things like, well, maybe it's the company cell phone or the company computer or the company car or some of those types of things. When you're in a position that you might otherwise qualify for benefits like that, you still get taxed per se on the fact that you have these things because some value should be added to what you're doing. But if you look at it otherwise as to, I'd otherwise have a $500 a month car payment and I don't have to make that car payment because I've got this company vehicle and they allow me to use it for personal purposes and they only put X number of dollars on my income because of it, you probably still come out ahead both in cash flow and in tax situations that you might be beneficial in having some of these things.
Right. And then I guess the last thing is if you have more control, let's say you're a business owner, now we can start talking about topic 2, which is actually hiring your kids into the business and having even more control. So let's move into that now. So hiring the kids in the business is another strategy that we work with if you are actually the owner of the business. Or it could be, technically, it could be grandma and grandpa's business, mom and dad's business, whoever. But there, again, there's some tax benefits to that as well.
Well, and the biggest area that people don't always think about when you're looking at this is the concept that paying your child is no different than paying any other employee. It shifts the income off of your personal tax return or off of your business income tax return, which is looked at as your income, and shifts it into a child's tax bracket and sometimes unreportable. So the one question that the first thing is, well, okay, does my kid even need to file a tax return? And if your child is receiving less than about $6,000 of income, they don't need to file a return at all. So first of all, that's not being reported on an income tax return. Now there's a W-2 that should still be issued. So pay attention. You're still reporting it to the government, but it's not in the same format of income taxes. But the second piece of it is that it's not taxable. That tax bracket is actually 0. Whereas if you left it on your return, it's at minimum going to be in 15, maybe 25. Heck, it could be in 39.6 this year. So if you can reduce the tax bracket down to 0, why not take the opportunity? And so that's the first piece, is thinking about, well, how do I, we'll call it income shift from my brackets or my income to the child's income, which I know you do in your world a lot related to, again, financial aid opportunities or other need-based situations.
Correct. So again, there's that double benefit of if you can shift income from mom or dad's to income, I guess, or the family income and move it to the student, you're certainly going to reduce your income as far as financial aid is concerned. So that works well in some situations. Now, sometimes we don't qualify for need-based aid. The income's relatively high, but then we get a bigger bang because if your income's relatively high, your tax bracket's relatively high, and you're in higher tax brackets. So now you get a better tax benefit for hiring the kids.
Right.
So we need to be careful. Hiring the kids in the business is a great strategy, but it can influence need-based aid. So if you pay the kids too much, it could reduce your need-based aid. And that line is somewhere in the neighborhood of $6,000 on the federal forms. If you're doing the CSS profile at some of the other institutions, if you pay them more than, I think it's like $2,300, it can have an impact. Again, it's a cost-benefit analysis, though. You may go ahead and do it anyway because just because you're eligible for need-based aid, all you might get is a loan, as an example. So you say, well, gee, I have to give up a loan, but I get a couple thousand in tax benefits. Well, I don't really want the loan anyway, so I'll go ahead and do it.
So again, it sounds like it's a planning opportunity. You need to be thinking ahead for tomorrow more so than handling what happened yesterday.
Exactly. So again, as you're approaching college, if you think you can hire your kids, and then I've run into this a lot where mom and dad have the kids working in the business, but they just choose not to pay them. So it's a family restaurant and the kids show up and they bust tables. And if they show up and work hard all day Saturday, dad slips them $50 to go spend on their cell phone and whatever, but he doesn't report it. He doesn't do anything formal with it. It's just a way for the kids to earn their spending money.
And in most cases, those are missed opportunities on the business tax planning side of things that, had you taken opportunity to do something with that, even if it's small amounts, they can still add up over time.
Well, exactly. Well, and sometimes it's not 50, sometimes it's 150 or whatever it might be. So, okay, so if we're going to hire kids in the business, and let's say our goal is to pay them $5,000 as a way to be friendly to financial aid and yet moves enough money that it's worth the time and effort. What would we have the students do, or what can the students do as far as work?
Yeah, and that'll be your biggest catch-22 is that usually when you want your child to earn a specified amount of money, the work that they do needs to be worth that specified amount of money. So there's a couple of things. I mean, number one, they actually need to perform a service. So what is that within your industry that they can do? Sometimes it's filing paperwork or shuffling papers. Sometimes it's going to be a service-related activity where they could build something or organize something. It might be cleaning the office space on the weekends. It might be any variety of things. You've got to fit it to your business. What are they qualified to do and able to do? Your 4-year-old isn't probably going to be very valuable in your business activities, but your 10-year-old might have something that they can start to do. Now, is it worth $5,000 a year? You've really got to measure that, again, usually with your tax professional, to make sure that what they're trying to accomplish is going to pass the test.
Right. But now when you get to your 16 or 17-year-old, now you're saying, well, I mean, I'm pretty sure you can't pay them $250 an hour to empty the waste baskets, but what could you pay? I mean, whatever fair wages,
sure. So, I mean, at that point, I usually would say measure it against the other people in your business as to what they're being paid and the duties that they're being performed. If you have a lot of people working in your business for minimum wage, working 20, 25, 30 hours a week for doing what I'll call the day-to-day work of your business, and you bring your kid in and they start performing a service that we'll call as a lesser degree of value to the business, and you want to pay them $10, $12, or $15 an hour, well, you're probably getting a little bit heavy as to where you can go with that. You're not being equitable across the levels of service. But if you've got a business where most of your employees are making the $10, $12, $15, $20 an hour type of thing, and you bring your kid in at minimum wage to perform the services they're at, you're just fine. Now it's a matter of just simply documenting when they work, how often they work, and what they're doing while they're there, and you've got the ability to pay them fairly. So you need to measure it against what the child is performing as a duty, as well as then what the rest of your staff is doing in relationship to your business. Just using my own examples. In the summer months, we have a lot of cleanup to do. It's not our busiest season. We have files that need to be emptied, old information that needs to be either shipped or shredded or things like that. Well, kids of many ages, but especially teenagers or young teenagers, have the ability to come in and spend 4 or 5 hours a day coming in and doing that during the summer months. They're not in school. They've got the ability to be there, and it helps them earn a living. So we've done this, whether it be with our own children or with other youngsters, as a way to earn some cash in a what we'll call unqualified position, and they're thrilled to make $8 to $10 an hour to do that kind of work.
Okay, so if you do hire your students in your business and pay them a fair wage for what they're doing, how do you protect yourself from the IRS? And I guess it sounds like you need to have some justification and some filing and some bookwork done in order to be legitimate.
Right. You keep records the same you do for any other employees. This is a bit more challenging when the only employees in the business is your family. So we do have a few things that you'd have to talk about separately for that. But in the assumption you already have employees, you're going to treat the children and they're going to be subject to all the same rules, regulations of every other person within your facility. And so you're going to have paperwork for hiring paperwork. You might fill out an application. You probably don't have to take a resume in this case, but you're going to fill out an application. You're going to fill out the proper employment paperwork. You're going to make sure that you've got all the authorizations you otherwise would need to hire any other employee into your business. And then the same thing with reporting their duties. You should have a record of when they worked, how often they worked, what they did while they worked, just like you would for any other employee in the business.
So just keeping time cards and the things that you might do with other employees where they punch in and out.
Correct.
And then when it's all over, you're going to also have to issue W-2s and...
Correct.
So for a lot of family businesses, especially smaller businesses, you may not want to deal with all this. So I know there's payroll services out there. I know an add-on service at your location there. You also would do some payroll. So could we hire a payroll service to hire our teenager in our business?
Sure, you could. Usually it's going to be a cost-benefit thing like you've started mentioning on other things. If this is the only reason that you're doing it, there's going to be a cost associated to utilizing an outside service. And you hear pricing goes all over the place, but in general, you're going to have a cost either per payroll or per month It might be as low as $25 a pay period or $50 a month or something like that to do that, but you're still going to have a cost associated to processing it. Now, if you already have 6, 8, 50 employees, and this is just another 1 or 2 added onto it, it's a minuscule cost in relationship to adding another employee when you're dealing with it at that level. But most of the time, it's that concept of I don't want to do it wrong. I want to make sure everything's paid timely and filed correctly. And so therefore, any of the costs that I'm paying to get it done is the type of thing that it's worth it to make sure that it's done correctly and I don't get in trouble in my business in order to make these things happen appropriately.
All right. Now, what if your student goes off to college now? Could they actually work off campus, so to speak? Do they have to be at your location?
Not necessarily. So now, again, it's the same thing. Every business needs to be a little bit aware of what's going on and how they do these things. But, the biggest thing I see for, high school and especially college age kids, that you're not necessarily coming in, quote unquote, to work, but you're still performing a valuable service. Between technology, number one, you can work remotely. So if it's something you can log in or provide services away from the business, that's one opportunity that's there. But marketing opportunities, online social media opportunities are areas that you can do this from anywhere. If you can create that buzz or build awareness or brand name or assist in production of materials and marketing information, there's a lot of things you can do without having to come and sit in a cubicle in someone's workplace in order to make your dollars.
Right. So I've seen a couple examples of this. So I've seen a father and son team where dad was essentially, I guess he's a self-employed marketing person, and his son, who is now in college, does a good job as a writer. So they formed a business together, and now he's an employee, and they actually do additional writing services that the student is able to do from college. So
sure,
he helps, write blog posts or social media or advertising or business cards or whatever needs to be created, but he can do it from afar. I think another great example that I've seen is where families start a kind of a side business on purpose because they know that the kids can participate in it. Again, another example that I've seen, someone selling sunglasses at State Fair. He bought into the business, kind of used his capital to get it started, but then he hired the kids, and they're the ones that spend the 10, 12, 15 hours a day, every day of the fair, actually hustling and selling the glasses. And so there's nothing illegal about that type of thing.
No, not at all. And I've got a client that does something similar from that standpoint, and it's at farm stands. So they spend the summer selling, in this case, it happens to be gourmet popcorn, but it's, they go around to the various communities. Again, you're right. The kids aren't in school during those months. They're able to sit there for 8, 10, however many hours it is on those days that the farmers market is open and sell these products. And these are, in this case, it's high school or college age kids that are responsible enough to do that unsupervised. And like you say, it's a secondary business on the side that only operates for these periods of time.
All right. So I think we've covered hiring the kids in the business. And again, just to be clear, there's a lot of benefits to hiring the kids in the business, but there are a few pitfalls. So I think you need to work with your tax professional. And if you're working with someone that's helping you with college planning, try and get that all coordinated, because I think there's a lot of different T's to be crossed and I's dotted, and everything needs to be working together in that plan. But let's wrap things up here. So I appreciate you spending some time with us, Tim, and giving us kind of the CPA's perspective of how the tax planning may work in college.
I appreciate the opportunity. Thank you, Brad.
All right. Thank you.
The latest tips, tricks, and tools you can use today. This is Brad Recommends on Taming the High Cost of College.
Today, I'm going to recommend a website called meritaid.com. It's a large website that tracks a bunch of scholarships for various schools, and you're actually able to sort the scholarships based on a school that you're interested in. So as an example, I'm at meritaid.com right now. And as I click into it, I went to California schools, and now I see University of California, San Diego scholarships. I click on that, and 26 scholarships are available. The smallest one is a $500 award. Looks like the largest one is a $10,000 award. And they have names like the Liddell Family Scholarship, and the Alumni Regents Scholarship, and the Dr. A.R. Mosa Scholarship, and the Rose Foundation Scholarship. So these are various scholarships available at this state institution that are sponsored by families and estates and alumni and various groups. There's one called the Alan Hanai Wong Scholarship. I'm actually going to click on that one. It's awarded to an entering freshman from Hawaii with a preference for students majoring in science and engineering. The award is a 4-year award up to $40,000, paid up to $10,000 per year. So that's essentially a $10,000 per year scholarship for 4 years. If you come from Hawaii, attend University of California, San Diego. Now, as I'm looking through the lists here at meritaid.com, there's a number of schools like this. San Diego has 26 listed. University of the Pacific scholarships is 78 different listings. University of California, Irvine, 32. Scripps College, 122. So some colleges work really hard at this. Other colleges haven't yet gotten their information posted on this website. Oh, here's a really big one. San Francisco State University, 487 different listings. So those are the California schools. I'm going to real quickly switch to a different state. Let's say Texas. Looks like there's about 40 or 50 colleges here at least. Some of the bigger ones, University of Texas at San Antonio has 260 listings. University of Houston, Victoria, 102 listings. West Texas A&M, 450 listings. Stephen Aust State University, 582 listings. Sam Houston State University, 413 listings. Texas A&M has 5 or 6 different listings here, it looks like, as far as different schools and different locations. Texas A&M Corpus Christi has 25 listings. Texas A&M Texarkana has 0 listings. So it's worth a shot. The schools that you're considering, you can come to this website, you can look them up and see what they have listed. Look through what's available and kind of get a feel for what might be available at the campuses that you're considering. So go check it out, and that wraps things up. I appreciate you guys spending time listening to the program. If you are interested, you can subscribe to the podcast at iTunes and Stitcher. If you need to learn more about that, pop me a quick email. Otherwise, if you could also give us a rating and review at iTunes, that would be helpful in keeping us available in the search engines. And send us feedback. If you have questions about the things that you're learning, there is a feedback mechanism where you can send a recording through our website at tamingthehighcostofcollege.com. There's a bright orange button on the right side of the website. You can click on that and use your computer to record a question or a comment, and we'll get that sent to us. If you send us questions, we'll compile them and answer them in future podcasts. Again, thanks for listening, and we'll see you next time.
Thank you for listening to the Taming the High Cost of College podcast. Now it's time for you to take action. Head to tamingthehighcostofcollege.com for show notes, bonus content, and to leave feedback for Brad. The next step on your college journey starts now.
Brad Baldridge is a registered representative of Cambridge Investment Research and an investment advisor representative of Cambridge Investment Research Advisors, a registered investment advisor. Securities are offered through Cambridge Investment Research Incorporated, a broker-dealer and member of FINRA and SIPC. Brad owns 2 companies, Baldridge Wealth Management and Baldridge College Solutions. The Baldridge companies are not affiliated with Cambridge Investment Research.